The European Central Bank's upcoming assessments of bank balance sheets may include in-depth details on their government bond holdings to be credible. Joining me on the line now to discuss this is Dr. Christian Schulz, Senior Economist at Berenberg Bank in London. Christian, the ECB will directly supervise 130 top Eurozone lenders like Deutsche Bank and Santander from October next year and wants to make sure they're adequately capitalised before taking up the reins. What factors have triggered the ECB to start doing this now, and what are the benefits?
Ahead of it taking over the supervision of all these banks in Europe with all their differences and risks and potential pitfalls, the ECB needs to know as much as possible about potential risks in their balance sheets. So the ECB has planned an asset quality review exercise which starts next month, in which the ECB will look in detail at all the balance sheets of those banks which is going to supervise. It's probably going to do that in a focused way on those issues which really matter. One of them seems to be government bonds. That asset quality review is then probably going to be followed by a stress test, and after that we should know how healthy these various banks in the Eurozone are, how much capital shortfalls they have, and where the money for that is going to come from. The Eurozone at the moment suffers from what the European Central Bank calls financial fragmentation. Essentially, German investors don't trust Italian banks. Therefore, Italian banks have a much more difficult time and find it much more expensive to finance themselves on the markets than German banks. So it's a breakdown of trust, and the ECB stepping in will hopefully increase that trust. So it will have an overview of all the European banks. It can guarantee similar standards across the Eurozone, and hopefully this asset quality review will also increase transparency for the markets, in the hope that afterwards investors will trust all banks equally as long as they have similar balance sheets.
Is this good news for banks, or will they be wary of being monitored and under the microscope a bit more?
It is a fine line to walk. Of course, banks have to keep some of their business relatively secret, already for competition issues, but also because ultimately these balance sheets are so complicated that there has to be a degree of trust. At the same time, we are in very peculiar times. Trust has broken down. It needs to be restored. So we do need some extra transparency at the moment, more than we usually do. Well, the negative consequences could be for the shareholders of these banks. If the ECB comes to the conclusion that banks need extra capital, somebody has to come up with it. That's either the shareholders or potentially governments, which would then crowd out the shareholders. So in any case, if a bank is found to have a capital shortfall, that could be negative for shareholders. But that's a short-term problem. In the long term, actually, shareholders should benefit, because once trust in their institutions is restored, they should be able to finance themselves more cheaply on the markets. That should increase margins and profits, and ultimately dividends, and thus the value of the shares of the investors. So short-term pain, long-term gain.
How will this affect the way that the banks operate?
Well, that really depends on regulation rather than the asset quality review, and the ECB is not going to take over regulation. So processes like the Basel process and the various EU initiatives to regulate, these are going to have a much bigger impact on the way banks operate than this asset quality review and the ECB's oversight, which are one-offs, really.
Finally, the big financial story of the week is the FOMC meeting. How will the outcome affect the Eurozone?
Well, it is indeed one of two major events this week, and indeed in the second half of the year, the German elections on Sunday being the other very important event. The FOMC meeting, of course, will probably just reflect what markets already expect anyway, and that is that the Fed will not continue to provide as much stimulus as it has in the past. So we expect the Fed to what they call taper the monthly asset purchases. The The consequences for the Eurozone should not be too strong, at least not of the decision tonight. However, that shift in policy from the Fed, which has really begun already back in May, has led to higher interest rates, not just in the US, but also in parts of core Europe. So far, luckily, it has not had any major impact on the crisis countries, the countries in the south of Europe, which are much more sensitive to borrowing costs than the northern ones. So I think there's, if any impact, it's going to be very limited impact on the Eurozone.
Christian, many thanks for joining me on the line for this discussion today, and we'll leave it there for now. Bye for now.